Why hundreds of U.S. banks are at risk of failing. Hundreds of small and regional institutions throughout the United States have been enveloped in a striking sense of stress in recent years. More than 280 banks are currently addressing the dual issues of commercial real estate loans and potential losses associated with higher interest rates. This turmoil will probably lead to additional bank failures or, at the very least, several banks falling below their minimum capital requirements. Nevertheless, it is imperative to recognize that this crisis primarily impacts smaller institutions as opposed to large, systemic banks. Many businesses and individuals have experienced substantial increases in financing costs as a result of the rapid escalation of interest rates. This sudden increase in expenses may result in defaults for certain debtors if they are unable to meet their new financial obligations. Consequently, a staggering $929 billion in loans are scheduled to mature in 2024. This circumstance has resulted in an unprecedented number of loans being extended beyond their original due dates in 2023. Regulators are currently engaged in a covert effort to provide support to lenders who may be at risk. They have been distributing confidential reports that encourage banks to increase their capital reserves. The objective is to reduce the incidence of failures using successful capital raises or acquisitions by more resilient banks. However, the rate of bank mergers and acquisitions has significantly decreased in recent years. The potential consequences of this stress on lesser banks for the U.S. economy are significant. Once again, we are witnessing the emergence of comparable strains a year after the collapse of Silicon Valley Bank. Both main and regional bank indexes are still grappling with the repercussions of the bank failures that transpired in 2023. Even the most robust institutions may suffer from a loss of confidence, even though the majority of these banks are financially stable. The exposure of small banks to risk. The banking sector in the United States is extensive, with a total of approximately 4,600 banks. The United States has approximately 4,000 minor or community banks, in contrast to many developed economies that lack regional and community banks. These institutions collectively manage assets that are approximately equivalent in value to those of J.P. Morgan Chase, the largest bank in the United States, which has $3.2 trillion in assets. Currently, community banks, particularly those with assets between $1 billion and $10 billion, are the most affected by the tension. These banks are the majority of institutions that are experiencing substantial strain as a result of their high exposure to commercial real estate and the potential losses that may result from rising interest rates. Brian Graham, the leader of the Claros Group, has analyzed 4,000 institutions to evaluate their risk levels about commercial real estate loans and interest rate sensitivity. Their research indicates that 282 banks, which collectively possess assets worth nearly $900 billion, are susceptible to risk. The majority of these banks are minor lenders with assets under $10 billion, although a few larger institutions have also been identified. This analysis emphasizes that the majority of potential issues are concentrated among mid-sized to smaller institutions, which are, by their very nature, less systemic. These smaller institutions, despite their diminutive size, are essential in providing support to communities, particularly those that are situated in areas that are remote from major metropolitan areas. The failure of these banks could seriously impede the economic development of these areas. Essential credit is provided to nonprofits, local governments, and smaller and medium-sized enterprises by regional banks, which collectively manage assets worth just under $3.1 trillion. Businesses may be compelled to seek services from larger banks, which may be more expensive and less personalized in the absence of these institutions. The negative consequences of minor bank failures are generally more indirect for individuals. Although the majority of these institutions are stressed rather than insolvent, the broader economic implications are still apparent. The strain on these institutions can result in a decrease in investment in local developments and a decrease in the number of employment opportunities. The Federal Deposit Insurance Corporation, FDIC, has a strong track record of protecting deposits, but the broader community can still be impacted by the effects of a stressed financial system, even though depositors are protected up to $250,000. The influence of commercial real estate loans. On a global scale, the commercial property market in the United States is the largest, and banks underwrite the majority of these loans. Historically, commercial real estate loans have been more prevalent in regional and smaller institutions. This is not inherently the result of subpar decision-making. Rather, it is a result of the bank's inability to compete with larger institutions in other lending sectors for scale. As a result, they are more susceptible to fluctuations in the commercial real estate market. Commercial real estate loan payments may become more expensive for debtors when the Federal Reserve increases interest rates. Defaults may occur if debtors are unable to afford these increased payments. Federal Reserve Chairman Jerome Powell has acknowledged that bank failures are unavoidable in this environment. The Federal Reserve has identified institutions with a high concentration of commercial real estate and is currently collaborating with them to guarantee that they are effectively managing their risks. Since March 2022, the Federal Reserve has implemented 11 interest rate increases. These increases have resulted in substantial unrealized losses for banks that hold fixed-rate assets, including mortgages and bonds that were issued at reduced interest rates. The value of these fixed-rate assets decreases as interest rates increase, which exerts pressure on banks' net interest margins. Traditionally, banks generate profits by accepting deposits at a fixed rate and lending at a higher rate. However, this dynamic can invert, resulting in a squeeze on banks' margins as rates increase. These losses are realized when banks dispose of assets that have declined in value. The current environment presents substantial challenges, but it is anticipated that well-performing banks will effectively manage this interest rate risk. Acquisitions and mergers. Banks have two primary alternatives in response to these obstacles. Either they can modify their operations to align with their current capital levels, or they can raise additional capital. The latter alternative is more advantageous, as it can be accomplished through private sector investment rather than government subsidies. The issue is not pervasive insolvency, but rather a substantial number of undercapitalized and stressed banks. New York Community Bank serves as an example of a successful capital raise by securing more than $1 billion from investors and strengthening its financial position. Nevertheless, the number of bank mergers and acquisitions has decreased significantly, reaching a 40-year low in 2023. The total value of these transactions was the lowest since 1990, with less than 100 bank acquisitions consummated. Regulatory scrutiny has also increased, with certain institutions contemplating more stringent supervision of merger and acquisition transactions. For instance, recent regulatory opposition hindered Toronto Dominion Bank's acquisition of First Horizon Bank for $13.4 billion. Although concentration issues are a matter of concern at the mega-bank level, they are not as directly applicable to lesser, struggling banks. In collaboration with bank leadership, regulators are actively addressing these issues. The situation continues to be fluid as there are ongoing endeavors to guarantee that banks effectively manage their risks and raise capital. The number of bank failures is anticipated to be lower than initially anticipated if private capital can be effectively attracted and if consolidation among smaller banks occurs despite the current challenges. The current situation may unfold over a similar time frame, with potential peak losses and delinquencies arising in the next 2 years, drawing parallels with the Great Financial Crisis. The current stress in the banking sector is distinct from the 2008 crisis in that it is primarily affecting smaller institutions as opposed to the largest banks. In summary, ultimately, it is the individuals who utilize the banks who should be the focus of bank regulators. I believe that this reinforces the notion that the policy priorities are less urgent when discussing smaller institutions, perpetuating the notion of too big to fail. The majority of these banks are not insolvent or even near to it. I believe that the number of bank failures is truly too low. The fact that our banking system is distinct from that of the majority of other economies provides us with the flexibility to permit those banks to experiment, innovate, and attempt new things, some of which may not be successful. We are unable to accomplish this with the largest institutions in the nation. The economy is overly reliant on their sustained operation, and they are simply too large and interconnected. We cannot tolerate the failure of extremely large banks. However, the economy will function satisfactorily in the event of a $1 billion bank failure. Thanks for watching. If you enjoyed the video, don't forget to like, comment, and subscribe. See you in the next one.